Looking for one last boost to your studies before the exam? Try our revision package. For just $10, you get 7 days access to our entire ACCA Performance Management exam course. Go through our comprehensive playlist, picking and choosing which concepts you want to cover and which questions you want to practice. Use our filters to revise the most commonly tested and difficult concepts. Go through our question videos for that all-important exam practice. Your choice. Hopefully, it'll be the final stimulus that you need to go on to ace the exam. And now, on to our video. Hello everyone, and how are you all doing today? So today we'll be doing another past paper question for the ACCA Performance Management exam. The question we're doing today is from the September-December 2021 released past paper questions. It's scenario 2, and it's for two companies, one called Flagco and one called Budgetco. So as always, we'll start with the requirement. The requirement says it's broken down into two parts. Part A, analyze the financial performance of the two airlines, including reasons for the differences in the two businesses' performance. Note, use the headings of profitability, liquidity, and risk to structure your answer. There are up to 6 marks available for calculations, 14 marks available in total for Part A. So this is one of your typical financial analysis questions. Now, you would recall, for example, in September 2016, you had Jungle Co. Then later on, you had Best Night Co. released in past papers, which we've already covered in separate videos, where it was both financial and non-financial analysis. The requirement was very similar, but it was for 20 marks. There wasn't a second requirement. In this question, there's a second requirement as well, which says, Part B, briefly explain how Fitzgerald and Moon's building block model could be used to manage the performance of a service business, for 6 marks. Now, the interesting thing is, Part B's requirement just asks us to explain how the building block model could be used to manage performance of a service business. It is not telling us to link this back to the case. So this is just going to be a generic answer describing the building block model and how it's used to manage performance of a service business. So we can quickly do this part. It's for 6 marks, get it out of the way, and then focus the rest of our time on the longer part, which will take more time, which is the financial analysis. So let's start. This is going to be scenario 2, and we're going to start with part B. We're going to shift it downwards afterwards so that everything is in order. Now you will notice that I'm using a Word document here rather than an Excel file. That's because if you look at the past paper itself, the space for the answers below both parts is in a Word document form or a word processing software form, not in a spreadsheet form. So that's why I said to keep consistent with the format of the exam, we're going to use a Word software document as well. Of course, the issue is, especially with the financial analysis part, the calculation will become tricky. We're going to have to manually insert tables, manually perform the calculations, which is why, as I've said, always remember to take a calculator along with you in the exam that you're comfortable with. The software itself on the computer-based exam does have a calculator as well. So if you're comfortable with that, that works too. So let's start with part B. Let's quickly talk about Fitzgerald and Moon's building block model, but keep in mind that the requirement doesn't just ask us to describe it. It asks us to explain specifically how it can be used to manage the performance of a service business. So we have to at least link it to service businesses. So we'll start by saying the building block model is particularly suitable to manage performance for service businesses, and then we'll explain how. This is because service businesses primarily generate revenue through the provision of services through its staff. The building block model helps manage the motivation and performance of staff, making it possible for a service company to improve in this regard. And now we can go into the specifics. Generic stuff to write. We'll start with the 3 building block models. The 3 building blocks comprise of, we can give subheadings. So we have the standards. The standards are the goals and targets set in order to encourage the staff to achieve a higher level of performance, or rather to obtain a higher level of performance by achieving these targets. Right? And we should also mention, because this was 6 marks, we should go into a bit more detail. Standards should be fairly set, achievable so as not to demotivate staff, and involve the input of lower level staff when being set to be realistic and take into account the situation at the operational level. Key thing to mention here are those 3 things: fair, achievable, and involve lower level staff. Right? If you remember, this was what we covered in our video for the building block model as well. Then we talk about the rewards, the second building block. Rewards are the motivators put in place to encourage staff to achieve the standards required. These rewards can be in the form of bonuses or promotions. They must be, and once again, there's 3 things: clearly set or clear, controllable, based on factors which are controllable by the staff and of a nature that they motivate the staff to want to obtain them. Right? There's no point in setting a reward which the staff doesn't want, because then it's not going to encourage them or motivate them to perform better. And lastly, we have the dimensions. Dimensions are the areas where the building block model suggests a company needs to primarily focus on in improving its performance. These include results, which are related to the main outcomes and goals the company wants to achieve, and determinants, which are areas where a company should excel in order to achieve its main goals. There are 6 dimensions. And we can break them down by numbering them. There's financial performance, and there's competitiveness, and we can describe them as well. How well a company is performing against its competition, how well, and financial performance, how well the company is performing with providing returns to its shareholders. And since these are the result ones, we'll just put a heading, results, and then we'll carry on with the determinants. And this time the numbering will start from 3. So the mnemonic we used to remember it is QUIF FC. FC was financial performance and competitiveness. Q was quality, how high the quality of the service is. U, utilization, how well the company utilizes its staff and assets. I, innovation, how well the company adapts to changes in the external environment. And F, flexibility, how quickly, rather flexibility, we should say how quickly a company adapts to changes in the environment. It's better to say innovation is how well the company introduces new services to stay ahead of competition. It could be products and services, but in this case we're specifically talking about service companies. So yeah, that's more than enough with regards to what the building block model is. These are the generic points that you need to always hit though, and those are that 1, talk about the 3 building block models: standards, rewards, and dimensions. Always mention the 6 dimensions and that they're split between results and determinants. For standards, mention that there's the goals and targets and that they should be fair, achievable, and involve low-level staff. For rewards, mention that they're motivated and should be clear, controllable, and be able to motivate staff. So now let's go and start with part A. So we'll just keep moving this further down and have our answer for part A. Okay, so it says analyze the financial performance of the 2 airlines, including reasons for the differences in the 2 businesses' performance. Just the financial performance, no need to talk about non-financial performance, and we need to talk about why there's a difference between the 2 companies' performance. Now, interestingly, they said, note, use the headings of profitability, liquidity, and risk to structure your answer. There are 6 marks for calculation, so we shouldn't go into too much depth after that. We should have 6 core ratios, maybe a few more if necessary, but not go into too much more detail. And since they've already given us the headings, they've sort of indicated which areas we need to focus on. Now, if you remember with Jungle Co or Best Night Co, there's no such indication. They just tell you straight off, analyze the financial and non-financial performance of the company. So we started with a case and went through the case sentence by sentence and then linked things we picked up in the case back to the numbers, because we needed to do that because there was no hint on how we should start the question. Here, this specifically told us profitability, liquidity, and risk. So in this case, it's better for us to start with the numbers and see what ratios we can calculate for each of these areas, and then work back and analyze those ratios in the context of the overall case scenario. So first, we'll just put our headings so that we follow the requirement. Always a good idea to start by structuring some headings for your answer before moving on, so that you make sure that you don't miss any requirement. So we have profitability, liquidity, and risk. Let's go to our scenario. So they have given us some information above, not much, but there's something there. And then they've given us the statement of profit and loss for both companies, the statement of financial position for both companies, and a note, current assets include inventory, okay, and other information for 31st December. So profitability will mostly focus on the income statement. Liquidity will mostly focus on the balance sheet. Risk would be back and forth between both of them. Let's see what's given so that we can write down some ratios we can use in both regards. So in the income statement, we have total revenue and operating profit given. Straight off the bat, we can calculate operating profit margin based on this, right? So we'll just note this down so that we know which ratios to calculate. In fact, let's calculate them while we're here, right? So let's insert a table. We'll need the two companies and mention of the ratios, 3 columns. Okay, so let's put in our numbers. We'll have the operating profit margin. Again, it's not an Excel sheet, so we can't put in the formula, but we should still put in the numbers used to calculate these operating profit margins. We need to give the headings as well. 2 rows above. Yeah. So flag co and budget co. So like I was saying, we need to put in the numbers as well. Why? Because it's very easy to make a typo in the calculator and get the wrong final answer. So to make sure that the examiner still gives us some marks, we should at least put in the correct numbers in our working so that the marker knows that we were going with the right formula and that the mistake is simply due to a typo. And for budget co, operating profit is 404 million over 6654 million. So 404 over 6654. We'll do all the calculations in one go once we have the numbers down. Okay. After that, they've given us the interest cost, finance cost. Operating profit, which is the EBIT over interest cost, can give us the interest coverage ratio, which is good from a risk standpoint. So let's copy this down and include that for the risk calculation. So we'll have the interest cover ratio. We're basically going to show the ratios on top in one place and then talk about their analysis below them for each heading. So interest cover ratio, our operating profit will stay in the numerator 1239, and the finance cost of 250 will be in the denominator. And for budget co, 404 over 50. Other non-operating costs, I don't think those would be too relevant right now. Profit before tax, potentially we could calculate profit before tax over total revenue, but would it really add something? We'll see. But there's just one profitability ratio right now, operating profit margin. Let's see what the balance sheet gives us. So it gives us the non-current assets, current assets, total equity, non-current liabilities, current liabilities, and total liabilities and equity, shareholders' equity. So the main subgroups within a balance sheet. So we could use this to calculate two things. Remember the 3 ratios that go hand in hand: operating profit margin, asset turnover, and return on capital employed. So we already have the operating profit margin for profitability. We can also calculate the asset turnover since we have total revenue above and assets over here, and return on capital employed, which is your operating profit over your capital employed. Since we're going to do all three ratios together for the asset turnover, rather than using the typical formula of sales over total assets, we're going to use sales over capital employed. So we'll just have a calculation for capital employed separately. Otherwise, putting it as a full working will make the table a bit weird. So capital employed is going to be our total assets, 15376, minus our current liabilities of 5700. And for budget co, it's going to be total assets of 4062 minus our current liabilities of 116. And then we'll use the same capital employed in our asset turnover and ROCE. We can use ROCE because it's a commonly used acronym. It's better to explain return on capital employed, but even if you just say ROCE or ROI, for example, for return on investment, it's fine because it's very commonly used. The asset turnover will be sales over total assets. Sales, as we know, is 11,333 for Flagco. This will be over whatever the capital employed is. And for budget co, it's going to be 6654 over whatever the capital employed is. Likewise, ROCE is simply going to be the profit margin, 1239 over the capital employed and 404 over the capital employed. So we have three ratios in profitability, one in risk. Let's see what else we can talk about. Liquidity, there is of course the current ratio that we can talk about. So let's just format this. Because there's a heading, it should be centralized, right? So we'll just copy these down below. And just to be clear, just because there's three headings doesn't mean we have to equally focus on each of these headings. Some headings will have more ratios and more points, others will have less ratios and fewer points, right? So keep that in mind. Current ratio is simply your current assets. So 3404 over your current liabilities, which are 5700. So it's below 1, so that's a bad sign. And for budget co, it's going to be 885. We can see budget co is a much smaller company just by the numbers being much smaller in the balance sheet, over 1116. We can also calculate the quick ratio because note 1 says current assets include inventory of 2.1 million and 1.1 million respectively. But wait, the numbers themselves are in millions as well. Please be careful about the heading. Sometimes they're in thousands, sometimes they're just dollars straight off, sometimes they're in millions. But these are in thousands of millions. If current assets inventory is just 2.1 million and 1.1 million, that's nothing compared to the thousands of current assets. So the quick ratio is not going to be that much different from the current ratio. So I don't think we need to calculate it then. We'll just mention, given that the inventory values are so small, calculating the quick ratio will not be much different from the current ratio. Right? So we explained that in a one-off point. Okay, what else? Balance sheet, we can calculate the gearing ratio. So we can say gearing ratio, and we can mention down below, because remember, gearing ratio can be calculated in many ways. So we should mention how we are calculating it. So we'll put a star here. The gearing ratio has been calculated using interest-bearing debt, and we can mention these are our non-current liabilities, over our total over our equity. Let's just go straight up, right? You could do it over total non-current liabilities plus equity, like total debt plus equity, up to you. But just keep one version of the ratio. You don't need to calculate all those different versions. Okay, so we have the gearing ratio as well for risk. What else? There's other information given. Fuel liters consumed, available seat kilometers, passenger seat kilometers. So available seat kilometers would be the total seats available. Passenger seat kilometers would be how much was used. So we can use passenger seat kilometers over available seat kilometers to get the, how do you say, the occupancy rate, or how much the flight was booked, how much the plane was full, right? So for example, these guys have 14,000 seats filled out of 21,000, whereas these guys have 14,000 filled out of 14,900. So they have a much higher occupancy rate, and that can have an impact. So we might have to calculate this ratio as well. And then there's the operating gearing, which is contribution over profit before interest and tax. So this would be relevant here, operating gearing. So this is going to be 950% and 820%. It's already given, but we'll use it in our analysis. And gearing ratio, like we said, non-current liabilities. So 5078 divided by your total equity, which is 4598. And for budget co, it's going to be 1001 divided by 1945. Okay, yeah, so I think that's all. We might have to do passenger seat kilometers over available seat kilometers. We can mention that. Plane occupancy rate, and we can put an asterisk next to it so that we mention what it's calculated on. This is calculated by taking the passenger seat kilometers and mine is American, so, and dividing it by the available seat kilometers. Okay, and the numbers would be 14,201 divided by 21,423 and 14,206 divided by 14,953. Now, just because of the Word document, this is going to take us some time to do the calculations, but let's quickly do them and then get on to our points. The good thing is we've covered our calculation marks as well. We've already done part B, which was for 6 marks. With these calculations, we'll have another 6 marks under our belt, and then we can quickly jot down some points in the remaining time. So let's just type in our calculator. First, operating profit margin 1239 divided by 11333, 10.93%. 10.93%, and for the other guys it's 404 divided by 6654, 6.07%, so much lower operating profit margin. Then capital employed for these guys 15,376 minus 5,700, 15,376 minus 5,700. So I was able to catch the typo there. Sometimes we might not be able to catch it when we're in a hurry. It's human error. That's why it's important to have the numbers down there. And for the other company, it's 4062 minus 1116, 2946. So that means this will be 9676. As well this. So 11,333 divided by 9676. Asset turnover is 1.17 for these guys. And 1239 divided by 9676. the ROC is 12.8%. Okay, and the plane occupancy rate, let's just calculate that as well. 14,201 divided by 21,423, around 66.29%. Let's just say 66.3%. And on the flip side, the other guys, the asset turnover is 6654 divided by 2946, so it's very high, 2.26 basically. So 2946, I'll copy this below, 2.26. Then the ROC 404 divided by 2946, 13.71%. We'll keep it at 13.7% to be consistent with the other ROC. And finally, the plane occupancy rate 14,206 divided by 14,953, around 95%. So this is going to cause a difference, and we have the differences above, so let's see what those are. Current ratios 3,404 divided by 5,700, so around 0.597. That's not good at all, but it's an airplane company, I think, in the case, so that could explain it. They usually have low ratios like this. Doesn't mean it's necessarily good. 0.793 for Budgetco. And then the interest cover ratio, this is also important, 1239 divided by 250, 4.956. Yeah, that's fine. So 4.96. And for Budgetco, 404 divided by 50, 8.08. So the interest cover ratios are pretty good. Then the gearing ratio 5078 divided by 4598, 1.10. And finally 1001 divided by 1945. Zero 0.514 or 515. Let's say 0.51. Okay, so we have our calculation numbers under our belt as well. Now let's just link all these things back to the case in the last few minutes that we have. So it says the country of JLand has two airlines, Flagco, its national airline, and Budgetco, a recent entrant. So off the bat, we can see that Budgetco is a new entrant into the market. Flagco is an established one because it's a national airline. Flagco was government owned until 10 years ago, so it's been there for a long time, and it now operated as a private company. Its mission is to be the airline of choice for long distance travelers. Mission statements are important, let's keep this in mind. So they're focused on long distance journeys. It charges premium fares, so high margin, high price, high margin prices, and operates routes from JLand's capital city to major airports serving the largest cities around the world. Many of its flights have durations greater than 12 hours, so longer flights. The majority of passengers traveling on business and are prepared to pay high prices, okay? So they're less price sensitive, which would help in getting higher margins. However, the demand for the business travel is very sensitive to economic conditions. That's important. Its fleet of aircraft is regarded as aging by the industry analysis. So their assets are getting older. So that would help boost the ROC in theory. Budgetco, on the other hand, was founded by a wealthy investor who invested their personal fortune in the company's equity. Its mission is to be the lowest fare airline on any route we serve. So these guys are the opposite. Flagco can charge high prices and high margins. These guys want to keep low prices, so their margins should be lower in theory. It offers flights to destinations up to 3 hours travel, shorter flights. Its fleet of aircraft are newer, so there's less depreciation on them. Most of its passengers are holiday makers who are a bit more price sensitive, and the demand for price appears to be relatively insensitive to economic conditions because they're gonna go for the holiday regardless. Okay, so let's write down our points. First, profitability. What's the first point we can make? Simple. One is high fares and one is low fares. So the profit margin should be low. Let's see. Operating profit margin for Flagco is much higher than BudgetCo. Operating profit margin connects our revenue or prices and our operating profit. So that's the reason we can say the operating profit margin for Flagco is much higher than that of BudgetCo. This means that Flagco is able to extract a higher profit margin from given its sales and prices as compared to BudgetCo. Right, we're using the language as compared to BudgetCo to link it back to the requirements in the case. This is likely because Flagco serves business class travelers who are willing to pay higher prices, resulting in higher margins. In contrast, BudgetCo has a mission statement to be the lowest fare. We'll copy be the lowest fare airline, meaning that the prices they charge must be low, thereby reducing their profit margins. Okay, so that's the first point for these two. Now, capital employed, obviously Flagco has much more, 9676 to BudgetCo's 2946, because they have a much larger fleet, because they serve the largest cities, major airports, long flights and everything, whereas BudgetCo is relatively new. Asset turnover, you can see that Flagco's asset turnover is much lower than that of BudgetCo, and the ROC as a result, because that's the product of the asset turnover and operating profit margin, is actually lower for Flagco as compared to BudgetCo. So let's talk about the asset turnover. On the other hand, the asset turnover is much lower for Flagco as compared to BudgetCo. What does this mean? This means that BudgetCo is more efficient in generating sales from its assets as compared to Flagco. So on one hand, this is surprising because, like we said, BudgetCo has a new aircraft fleet, so they have less depreciation, so their assets should be higher in theory as compared to Flagco in relative sense, because Flagco will have a lot of depreciation on their fleet. But on the flip side, it also means Flagco was government owned, then it changed to a private company. This will lead to certain inefficiencies within their operations because the change in management and everything, whereas BudgetCo has one person in charge. So there's more consistency in management there. Also, Flagco has more major routes serving the largest cities and long flights, so they might need more of a fleet as well. So due to these reasons, they have higher capital. The probable reasons for this could be that, firstly, Flagco is much older as a company and has changed its ownership structure from government owned to private, meaning that it is likely developed certain inefficiencies due to its scale and changes. Additionally, Flagco must serve major city flight routes and long flights, meaning they likely require more sophisticated, larger, and numerous aircraft as compared to Budgetco. This again will increase their capital, reducing their asset turnover. We can see the joint impact of the above on the ROCE, which is actually slightly lower for Flagco due to their much lower ROCE despite having a higher operating profit margin, right? And plane occupancy rate 66% to 95%. What point can we make about that? Well, it has to do with the actual, we can link it back to the asset turnover and ROC. The plane occupancy rate is much lower for Flagco. They still have to fill up the fuel in the plane, still have to make it travel the journey, but they're only getting money for 66% of their seats, whereas Budgetco on every flight are getting money for 95% of the seats. So on average per flight, they're getting more money out of it. So we can link it like that. We should also consider the fact that Flagco planes are occupied on average only 66.3% as compared to Budgetco's 95%. This means that Budgetco is able to generate more income per flight as compared to Flagco, which helps in their efficiency of asset management to generate sales and operating profits, leading to their higher asset turnover and ROC, right? So we've linked it all together. Lots of points made. Let's move on. We're low on time. After that, the current ratio. What can we say about that? Both companies have low current ratios, which is risky and bad, but they're airline companies, so we can talk about that. Both companies have low current ratios of below 1, which would suggest a large level of risk in managing their liquidity. We can link this to the interest cover ratio, which is very good. So they're still able to make their interest payments. The negative impact of these is somewhat offset by the fact that both companies have high interest cover ratios as seen below, which means they are still able to handle the interest payments on their debt. And we can talk about the difference. Overall, BudgetCo has a higher current ratio. This again could be due to them being relatively new in the market, leading to fewer suppliers, payables, and current liabilities, as well as a smaller organization leading to better size, a smaller organization size leading to better management of current assets. Okay. And finally, for risk, let's quickly just mention a couple of points and wrap up. Interest cover ratio we've mentioned already. Both companies have good interest cover ratios. BudgetCo has a much higher, once again we need to compare between the two, right? Ratio, meaning that they are better equipped to handle their interest costs. The reason is the gearing ratio. Look at the gearing ratio of FlagCo, much higher, double of BudgetCo, meaning they have much more debt. The reason for this is that FlagCo has much more debt than BudgetCo, given that their gearing ratio is more than double that of BudgetCo. This means that FlagCo has more in debt, leading to more interest expense, leading to a lower interest cover ratio. Right? This is to be expected as FlagCo is larger and has more capital, which can be used as collateral to obtain more loans. Overall, both companies are able to pay off their interest costs at the moment several times over. Okay, and lastly, the operating gearing ratio. Now, what can we say about the operating gearing ratio? Well, what does it really mean? The formula they've used to calculate the operating gearing ratio is contribution over profit before interest and tax, which is your operating profit. So what does this really tell us? Well, what it tells you is the difference between your contribution, which is revenue minus variable cost, and your operating profit, meaning your fixed or a fixed cost basically. And 950% here, what it basically means is, think about contribution, sales and variable costs. Both those things impact contribution. What is one commonality between both those things? The volume. The volume of units produced and sold impacts sales and variable costs. So that's what we can really take away from this. So if the volume of our units, which impacts both sales and variable costs and ultimately contribution, changes, goes up or down, it will have this much of a magnified effect on our operating profit. So if it's 950%, a 10% change in our sales volume, if it's an increase, for example, would increase our operating profit by 9.5 times or 95%, because this is 950%, right? 9.5 times. And vice versa. If our operating sales volume goes down by 10%, this will fall by 9.5 times. So both of these have very high operating gearing, again, to be expected. But why is that a bad thing? Well, for Flagco, business travel is very sensitive to economic conditions, meaning if the economy goes down and sales volumes start to go down, their operating profit will fall dramatically. For BudgetCo, it's not too much of an issue because they're relatively insensitive to economic conditions. One point of concern for Flagco is that their demand is sensitive to economic conditions. Given that both they and BudgetCo have high operating gearing ratios, small changes in sales volume can have large impact on the operating profit. For example, if economic conditions worsen, leading to a 10% drop in sales volume, operating profit for Flagco would fall by 95%, leaving them unable to pay off their interest costs. Thus, they are in a very risky position in that regard. Since BudgetCo is less sensitive to these conditions, they can still be they are still better off, though their operating gearing is also very high, also high enough to warrant concern. Okay, so we've taken more than the allotted time, but I wanted to make sure we got all these points across. In the exam, if you were running short on time, just leave the last few points and just move on, but make sure to fill out something for each subheading because that's important so that you don't leave anything blank. That's all we needed, the differences between the two businesses' performance, and we got there. We got the calculation, 6 marks. Analysis was very detailed as well, so we'll get quite a few marks for that as well. And we got the 6 marks for building block model. The important thing I want to leave you guys with, one, because we did the calculations and the building block model questions first, 6 marks for calculation, 6 marks for building block model, we already had 12 marks under our belt before we even started writing the analysis, even though by the time we got to the analysis, we only had a few minutes left before the allotted time for the question would be up. Secondly, section C questions, usually you have more time given that MCQs take less time, so you would be able to take a bit more time. That doesn't mean don't write the analysis, it does mean you need to write it, but make sure you hit points. It's better to make fewer points for each area rather than having 2 areas completely full and 1 area completely empty, right? That's what I'll leave you with. So hopefully this benefited you guys, and I'll see you guys next time.